Hello, everyone. Welcome to the market update for Tuesday, April the 12th. If you have any questions during the week, or if you have any questions that I don't get to during the live class, make sure you send those to Jerry at traderspro.com. Another thing to quickly point out as we get started, just remember this week is a short trading week. The market is closed this Friday for the Good Friday holiday, and so just make sure you're aware of that. Some of these holidays kind of catch up on you sometimes, where you're not expecting them, and suddenly you go. I've had days where I've just been so focused on the work week that I get ready to wake up, get ready to make the trades, and then realize the market's closed. So it can happen from time to time, but make sure you're aware of that. Just kind of treat today like a Wednesday. Today's the Wednesday of the week, and that means when we have the stock specific class on Thursday, that'll be our Friday when we have that class. So all right, now a lot of still getting a lot of back and forth in the market, and there's a lot of if you're watching a lot of CNBC or reading a lot of financial websites, you're getting the same back and forth arguments. One thing I talk about a lot is to try to ignore a lot of the noise. Try to focus on the trend as much as you can. Try to focus on what is actually happening and taking place. Learning how to read that price action. And if you can do that, it'll relieve a lot of the stress of trying to figure out who's right and what's going to happen. Are we going to have a recession? Are we not going to have a recession? Is inflation still getting worse? Is it getting better? If you're noticing this and you're spending a lot of time listening to people talk, you're probably finding that there's arguments on both sides, and sometimes there are good arguments on both sides, and you're left confused, wondering what you should do, who to believe and who to trust. And we'll trust the chart and trust what the chart's telling you. Focus on that. That's going to tell you what all that other stuff means, and it'll save you a lot of time of feeling like you got to watch CNBC all day long. Go to a movie sometime and enjoy your life. You don't need to hear people argue about whether the market's going to go up or go down if you know how to read the chart and read the price action. And that's what we're trying to teach you here in this class, is what are the steps to do that? How do we break down what's going on? And the philosophy that I have is I first want to take a look at what the overall market is doing. We're going to look at the indexes here in just a second. I want to see what the internals are telling me. And then I want to see if they look good, if they look like the market can go up. I want to start looking for individual stocks that also have good patterns and look like they're going up. If not, I want to stay patient and sit on cash if I have to, or as we learned over last week, there are some inverse ETFs that you could trade. Some of those have done very well in the portfolio. That you can still buy, that'll go up when the market goes down. You can still make money when the market is going down and still be long. Before I move on, though, before I get into that, I got a question, and it's a good question that maybe many of you have been wondering. If you look at the question was basically, if you look at the S&P. And let's look at a longer term chart here. Let's look at a 2-year chart. We've had this pretty decent pullback right here on the S&P. And yet, when you look at the bull market and the long-term signal here, we've been on this far right side of the bull market for forever. That hasn't even budged off of that. And the question was, how can we have this big of a pullback and this thing is not moving down? When is this ever going to move down? How bad does the selling have to get before we start to see this move down? Now, you have to understand that these these signals are based on algorithms, and these algorithms are based off of normal behavior over the years. Okay. Now, one thing we do know about the markets is they can sometimes do unusual things, and one of the things that we saw recently is we saw a market crash back in 2020 during COVID, that was sharper than it fell sharper than anything we'd ever seen before in the history of the markets. The market dropped dramatically and immediately, and it was so extreme that it had never done that before. So you're dealing with an event that's never happened before, and then the recovery from that, we came straight back up again, and the recovery from that was also extraordinary. So we look at this longer term chart here. We had that big drop, which you can't see here at the tail end of this, and then we had this straight move up right here, and really extended over. I mean, we hardly ever pulled back. We had this unusually long run up. So it throws off the algorithms a little bit. Okay, just to give you a little bit of an idea of the context of that. Typically when you're reaching the extreme tops out at 5 right here, but typically the extreme before, a very extreme range would be maybe a 7 or a 9 right in here, like the highest. You can see that we got up as high as 22, 20, might have been 24, up to 24. And then on that pullback, we're coming back from 24 down to 18, down to 60. I mean, these are just extraordinarily high readings. And so the indicator can't go any further to the right, nor should it, because it's not normal that should happen. Okay, it's set up right. It's just that extraordinary move that we had is causing it to show that extreme bull market. It's been extreme for a long period of time. Now, one thing you'll notice though is we're right at about that 5 reading right here. So now this gets back to what I've been talking about. I touched on this a little bit earlier last week, where I said, in context, we looked at the bigger picture. There's still a lot of room that we could correct of this trend and still just be normal. So people thinking that, boy, if the market would drop another 20%, that it would be it'd be catastrophic. That's not the case. It would actually be more of a healthy, more of a normal pullback within that long run up that we've had since that COVID bottom. And so so this is what can happen when markets kind of get just crazy, is that we can stop looking at reality and we can start just focusing on we start to focus on low probability events. We start to focus on the fact that maybe these type of readings are going to be more likely in the future, and so we ignore the fact that that we can pull back further from this point, saying, well, hey, it was just up there before. Why can't it go right back up there again? Why can't we go into another big stretch like we were in? And that's not reality. That's not probability. Okay? It's much more likely that we're going to return to normal, and normal over the last 150 years type normal. How markets have reacted for most of the time. Now this fits in pretty nicely with Elliott wave analysis, and in Elliott wave analysis, it focuses a lot on human nature, and human nature tends to repeat itself. That's why history repeats itself. That's why these patterns repeat themselves. There's a tendency, and one of the things phrases I listen for in the markets, people talking about the markets, is a key Elliott wave signal, which is when people start talking about it's different this time. Anytime you hear anyone on TV say, oh, well, yeah, normally when this happens, this is what happens, but I think it's different this time. We're dealing with a different world now. We're dealing with a different environment. I remember back in the internet bubble, that had to do with financial accounting and valuations. And the old timers were coming out and they're saying, man, there's no way that these stocks, these tech stocks, should be trading at these valuations. That's insane. It is crazy. These companies cannot maintain this. They're gonna crash. And the new generation at the time was saying, oh, you old farts, you can't value these companies like you do, the old railroad stocks. This is tech. This is something new. This is different. It's different this time. Well, what ultimately happened was the old timers were right. Those valuations could not hold up, and the market crashed, and the stocks crashed. And so anytime you hear that, well, it's different this time, or this is different, you can ignore what normally happens because I think it's different this time, or this time is unique. That's always been a red flag for me. It always starts to pique my attention, and it causes me to want to go opposite of whatever analysis they're talking about, because typically that means that they're sliding right into that human nature, and history is probably about to repeat itself. But that's something just to kind of keep an eye on if you're curious about that. We get another decent market sell-off, especially on the Dow or on the S&P. You're going to see that move. You're going to start to see that needle move. It'll move down to the 4, and you'll actually start to see it move in that direction. Now, again, we might not be there. Maybe we do attempt to rally again right here. We'll look at some things here in the near term of, how we're still in a state where we can go either way. But anyway, I thought I'd point that out because I did get a question on that. I haven't covered that for a while, and I know I have some new people that join from time to time. As far as the other indicators are concerned, we're still kind of right in the middle, not showing any extreme one way or the other, but also not really showing a direction, a strong direction one way or the other. Breadth is right in the middle under trending. Sentiment is still relatively high. The buy-sell ratios, you can talk about being able to visually see the whip sign that's going on. The sales went down, the buys went up, and then now the buys are going below the sales. The sales are going or outpacing the buys. A lot of that kind of whip sign going on lately. The overall market is down. It's still down below 1 here with the recent selling. Again, typically what that means is you want to see it get back above 1 before you want to, if you're going to be using the technique that we go over in the stock specific class on Thursdays, where you're looking for the high sectors, 98 strength rank, that process tends to work better when you have that buy sell ratio. This is of the entire market when that gets above 1. We're just below it, and any decent rally, and probably that doesn't mean we can't look for stocks that we want to put in the portfolio. That's what we did last Thursday. We said, boy, things are still looking a little bit bearish in the near term, but let's get ready. You can definitely be looking for patterns that you want to get ready to get into. But when and typically, if you do get that conversation, if they do go from hold to buy, there's chances a lot of other stocks are going from hold to buy, and that probably means this ratio is bumping up there above 1 or pretty close to getting up there above 1. It can happen very quickly. We were down below 1 back here, and within a day or two, we were up almost at 2. It had jumped so quickly there. And then the sentiment indicator is backed off of the overbought range. It got a little overbought right there and then pulled back. All right, let's take a look at our charts. Down here, here we're on that long-term chart right here. But again, you can see, one of the things that is going on right now is trying to figure out, and I talked about this last week a little bit too. This is always difficult with corrections and knowing if you're done with the correction. Was this the ABC correction? Is this done right here? And then we're trending up now. Here's the first move up. Maybe this is a pullback. and then we're heading higher again. That's definitely a possibility. We have to look at that as that could be taking place. Again, one of the things that worries me about that analysis is that we really didn't truly put in a bottom psychologically down here, where we got that fearful selling, that panic selling that usually creates that low. I know that sounds repetitive. But I know I have new people that join all the time, and I want to keep reminding people that's really puts in a good bottom when you can get that flush out fearful selling where panic is on the street. Boy, that's usually when I love to start jumping in and start buying at that point. The other possibility is that this was just the first part of the correction. Maybe this was wave A. This is a suckers rally here for wave B, which is usually what wave B is called, and we're in the midst of maybe getting another move lower for wave C. I still think this makes more sense for a number of reasons. Starting off with the fact that type of a move would likely create more of that panic selling that would put in that bottom. It would also be a move that would cause that long-term bull market indicator we just looked at to start moving off that strong bull market, thus creating a little bit more of a effect of a correction, an actual correction taking place. We're just not seeing a lot of strong bullish charts. You go back, and again, what I talked about last week with the week before with the Dow transports collapsing. We'll look at those here in a second as well. The chip stocks have been collapsing. Those tend to be leading indicators. If this was the correction, and this is going through an Elliott wave count here. An Elliott wave, just briefly. Elliott wave is you'll typically get 5 waves within a trending move, and then 3 waves in a corrective move. So you'll start off with wave 1, wave 2, wave 3, wave 4, wave 5, and then you'll get the larger correction, which tends to retrace the previous trend about 50%. Again, this is just real basic. Doesn't mean every stock is going to move exactly. This is more of just kind of the concept of how trends tend to work. Once that correction is done, you'll start to go into wave 1, wave 2, wave 3, wave 4, wave 5. Same thing will repeat itself, okay? Well, a couple things that really need to be pointed out here. There's a lot more to this. You can go to the YouTube channel and look for Elliott wave analysis on the Traders Pro YouTube channel, and there's several trainings on this. But wave 3, one of the characteristics of the wave 3 is it tends to be the most powerful wave, and it's usually the longest wave. Not always, doesn't have to be. It can't be the shortest wave, but the characteristic of it is it tends to be very forceful, very powerful. Usually, when as you're getting towards the end of wave 3, it's clear that the trend is up, that the buyers are strong, that confidence is high. You compare that to a wave B. The wave A is the first sign that a correction is underway. This often attracts the dip buyers because they think that once wave A is done, that the correction is over, that they can start buying. The characteristic of wave B is that wave B is a suckers rally. It looks like a time to buy the dip. It looks like you're buying the dip, and then it rolls over, and you get one more flush out move down right here, and that's why it's called a suckers rally. You got suckered into it, thinking it was done, and then you get that flush out move. And this is where fear kicks in down here. You think the end of the world is there, or how much further is this going to drop? And then that's usually when you're bottomed and you're going to start the process back up again. Okay. So understanding just that real basic part of Elliott wave analysis. First of all, if this was the end of that ABC, again, I pointed that out. We just didn't get the fear down here that you would expect. Okay. Then you say, okay, well, if this is wave one, this is wave two, then what should happen, what should follow should be wave three. Wave three should be the most powerful wave. It should be the strongest wave. There should be a lot of confidence in the buying. And that's just not what we're seeing here. Now, I'm not saying that couldn't show up. Suddenly something could happen and all this could change. But instead, what you have, at least at the very start of this, is you've got the chip stocks collapsing. They should be leading the way. They're usually going up before wave three starts. They're going up before wave three and the other indexes would start. Transportation stocks are collapsing. They would start going up before the Dow would start going up in its wave three. Okay. Now, so now you can look at other possibilities. Okay, well, what if this was wave A and this is wave B right here? Well, that kind of fits in a lot of what we've been talking about. This has felt like a suckers rally. And that maybe we're about to start to get wave three coming down. Again, it's still early yet because the market is still fighting that. It's fighting the drop. We started to drop. I got really bearish last Tuesday. Man, this market should drop tomorrow. We did, but then what happened? It held up. It resisted going down any further. We saw the big spike. Now again, their earnings season is starting this week. The bank stocks will start coming out. They'll start getting more in force next week because this week is a short week. But that can cause catalysts for a lot of these moves as well. They're usually earnings months. You usually get movement. You usually get volatility or some sort of movement. Now, by the way, another possibility here that would still fit into that this is a suckers rally or wave B is it could be that this is wave A right here, and that this is an A, B, C for wave B. So wave B actually ends right in here, near an all-time high, and then we get that big sell-off. Now how would I think that would be more likely a scenario? Well, if we do start to rally from here, and it's possible we could, we'll zoom in on this chart here in a second. Then pay attention to how it's rallying. Is it rallying in a really strong way? Are we starting to really get good aggressive buyers, people confidently buying, or is it sluggish? If it is really sluggish and it's going higher, but it's still a lot of doubt, still a lot of or there's few stocks that are participating. It's all oil stocks and energy stocks and things like that, or a very narrow rally, very few stocks rallying. Then that could still be that wave B, and then we could still get that wave C back down. Now, again, I'll be commenting on this class to class as we see things kind of play out. But it's nice to look at the bigger picture sometimes because too often we get zoomed into the near term and we can't always see what's really going on. So now this is what threw us a little bit last week, though, is that, we had this big run up right here. Again, I had trouble trusting that run up. I still felt like we had further to drop. And then we got this move down, tried to rally. This was last Tuesday right here, where it showed a very high probability we were going to drop after attempting to rally right here off this pullback. We did get a drop on Wednesday. Thursday, it actually looked like maybe it was trying to go higher, that maybe this was a bullish ABC pattern right here, and that we were maybe going to try to rally a little bit. There were some bullish looking patterns out there and some stocks. Then we rolled over yesterday and sold off further. So you can see it tried to rally. This is what I'm saying. If it tries to rally, but it's real kind of stagnant, that's a warning sign. if this was the end of the correction and it's ready to go, it should take off pretty strongly from there. But there's not a huge amount of fear in the selling today. It's not like I'd characterize it as real panicky. But again, maybe that kicks in the next couple of days. Maybe we are in that wave C down, and things just get uglier and uglier. Or maybe we get another day where it attempts. What I really like to see, and I was hoping it would happen today, was that we would have an up day today that looked like it was trying to rally, very similar to what we saw right here, where we opened right here and tried to rally, and then if we would have rolled over, and maybe that comes in the next day or two. Maybe you get a little bit of a sluggish move down. Maybe it tries to rally, but then gives you a bearish reversal candle. That's what I would love as a shorter term trader that likes to buy put options on those patterns. Give me an opportunity to trade something like that. But either way, this is not looking overly bullish the way the price action is playing out there on the S&P. The Dow, same thing. Dow's actually held up better than the other indexes. I think part of that is it's got other components to the index. It's a little bit more of a broad, well, not as broad as the S&P, but you've got stocks like Walmart that have held up with a selling recently. United Healthcare has done pretty well, rallied pretty strong off of, so it has pockets that have, even though some of the index or some of the stocks within the index have dropped, there's been others that have actually still been going higher. Coca-Cola and actually a lot of the healthcare stocks have done pretty well. Amgen. But it could also mean that it hasn't reflected yet that divergence with the transports. The transports are already down. The transports have already traded below this low down here. They've already gone below it. Now, I do want to point out that these types of divergences, when you're seeing divergences between the transports and the Dow Industrials or the chip stocks and NASDAQ 100, they don't have to be immediate that you see the result of it. That's why I'm not basing my entire trading strategy off of that divergence. I mentioned it. It's a warning sign. It's something you tuck away in your mind, but I'm not going to go, short the QQQs just because the chip stocks are at their February lows, or short the Dow just because the transports move below their February lows. Okay. But that it could be 2 or 3 months or so before it factors that in, but it's just one of those things that you want to just pay attention to and remember. It's kind of like when we talked about the yield curve inversion. It can often signal a recession, but it typically can be 4 to 6 months before you even see the results of that. And it doesn't mean the market would immediately drop ahead of that either. So you still want to focus on the current trend and what's currently happening, but it is something that as a reason down the line, if you see a bearish pattern forming on the charts and that yield curve inverted a couple months before, it's another one of those things that can give you confidence that the market could drop at that point. Now, again, try not to look at everything through one prism. It's possible that this could be an impulsive move up. This could still be a correction, an ABC correction that it could turn around and rally up a little bit further. But you want to see how crazy the last couple of weeks have been. So last week we get the drop. The end of the week we get a rally up. So far this week we got a drop. We're just whipsawing. And whipsawing conditions suck, but every trader has to deal with them. One of the ways I deal with them is to try not to do too much, or to really be focused on what is working and what is moving, and not try to speculate too much on what I think will start moving or anything like that. So, but that, again, if you're wondering why there are people coming on TV all day long with different opinions, it's That's showing up right here on the charts. It's showing up that these are professional traders that are moving the market. And when you see that back and forth like that, it's telling you they can't figure out where they want to go. And so you don't want to try. You got to be careful not to say, okay, well, I know where you want to go. I'm not trying to outsmart those guys. I want to wait until they decide where they're going, and then I want to follow. I want to be a good follower. I don't want to be good. I'm not trying to be a good predictor, so to speak. Because even if I get out ahead of them, I can't move the market in my favor until they discover what I've discovered. So I just got to be patient till they figure it out and then trade that direction. Qs have been a lot more impulsive looking down. They've been beaten up a lot worse. A lot of that having to do with the chip stocks. Russell 2000. Well, I think what's interesting here to point out, if you go to a long-term chart, so the Russell 2000 kind of peaked out in March of last year, and I told you for a whole year they basically went sideways. But if you look at the Russell tends to be more of a leading indicator. So it peaked out in March, and then, like I said, just went sideways. Look what happened to the S&P during that period of time. Here's March. Look how much further the S&P went higher. Again, that was a divergence. That was the Russell 2000 wasn't participating in that rally. That was a warning sign that be careful, not to trust that. Now again, it didn't mean we started shorting right there, but we tucked that away. We started to see that. We pointed out several updates, but as long as the trend was still going up, we still traded that trend. But that was a little bit of a warning sign that the Russell was peaking out right here and going sideways, and the rest of the index was the rest of the both other indexes were moving higher. And what I see here, I pointed this out, but it's good to visualize it again. So here was the bottom part of that range. There's that top part of the range. Did have a brief breakout right here, but then notice again how it broke down below it, and then it's rallied up to it. And it looks like it's getting ready for another move down. If you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. This is looking like it might have one more move down or a bigger move down. We'll see. Now, I also point out, well, if it can shake that off and get back into that range again, we might change our feelings on that. Maybe that'll look a little bit more like the bowl-shaped move. I like to see if it can kind of form a bowl-shaped move here. That could be a little bit more bullish. But as of right now, I'm leaning a little bit more to the bearish argument on that weakness is looking like we should be moving down. Bonds continue to see bond yields rise. Bonds are dropping and continue to drop. We are at extreme reversal risk, so we're due for a little bit of a bounce. We were talking about that last week as well. We're down in this area here. We've gone down even further, gone even more extreme. Overall, we're still in a downtrend. Now, as far as we've dropped right here, this is the key high right here. If it gets back above there, that'd be one of the first signals of a potential trend reversal. And you can see that's pretty far away. Now, what could happen is you could get a attempted rally and then another drop, and then that would be the key high, because that would be the next lower high right there. So I'm not saying that this is set in stone. That's got to get above here to signal a potential trend reversal, but nothing in this downtrend is signaling that it's done yet, except for the fact that you're extremely oversold but that's it. But you've seen, we've done that many times. We've gotten extremely oversold and the trend keeps going down. So not only do you want to see, this is really signaling the near term that you'll probably get some sort of a bounce here pretty soon, but it doesn't necessarily mean that bounce will turn into a trend reversal. You want to see more characteristics of higher highs, higher lows in that trend reversal before assuming that's reversing trend. Gold. Yeah, gold is still kind of in a sideways trend. I did kind of point out last week that you take this high right here and this low. It is looking like it's moving above this high, so it is looking a little bit more bullish based off of that. But the price action today is weak. It's an indecisive candle. Now there could be, there's other gold. You could look at gold miners. You could look at individual gold stocks, and they could have bullish patterns that look stronger than this. This is just the ETF for gold. There's a lot of tradable instruments. So, in fact, let's take a look at the gold miners real quick, the GDX. So you look at the GDX, these are the gold miners. They're looking like they're trending up pretty nicely. So where I may not be as bullish on gold itself, the miners are making a lot of money with prices in this area right here, and they're trending up nicely. That would be probably a better trade, would be to trade the miners where they're actually trending up pretty strongly there. So oil, I think is going on another run right here. It looks like to me, this is kind of an impulsive move up. Looks corrective. It looks like we had a little bit of a jolt today, and there's a lot of oil stocks that look real good. We'll look at some here on the update that I think you'll want to pay attention to. Dollar continues to move higher. It's getting into the extreme reversal risk area up here over bought. So it could start to pull back again here pretty soon. But the trend is clearly up. The VIX started to spike a little bit last week, but it's starting to, in the last couple of days off the selling, it's starting to elevate again. Yesterday we closed at the highs today, which usually doesn't do, and when it does that, it could indicate that fear maintained itself all the way to the end of the trading session. It's still still not up there at 30 or up here near these highs, which would indicate the market that's kind of freaked out a little bit. But we want to pay attention to that. Is it trending towards that? And if we start getting these whipsaw moves and volatility in the market, and you're seeing the VIX rise, that's going to be a bearish signal. On the other hand, if suddenly we get a rally and the VIX comes crashing right back down again to these lows, that would tend to be a little bit more bullish. And we'll watch for that this week, especially when we're in kind of this critical area where we could go either way. Chip stocks, again, continue to be ugly. And I continue to point out that, again, that was the big bullish reversal day that the markets had in February. Remember, I told you that low was going to be very significant. We broke below it back here in March on the chip stocks. We're back below it again here. Again, I think that's significant, and we're close to going to new recent lows on those chip stocks. So that's something to really pay attention to. Look at AMD and look at NVIDIA, and unless you start to see them rally 3 or 4 days in a row where there's a lot of volume coming in, they look strong, you got to assume that they're going to keep trending down, and that's going to be very bearish for the markets. Same with the transports. They had a bullish reversal day yesterday, but then reversed that right back down again today. They're also trading below the key February low and the March lows. So here all we really did was break down below that level, retest it today, and now it looks like maybe we're rolling over again. So not a very bullish sign there. And then Bitcoin has also dropped. So you're getting Bitcoin participating in the selling a little bit. And the problem here is, okay, you start to see all these different things looking more bearish, and then the thing that causes a lot of fear is you say, okay, well, where do you go then? A lot of times in markets, you could say, okay, chip stocks are selling off. Okay, I'll go into Bitcoin, and Bitcoin's trending up, and I'll just put my money in that. Or chip stocks are dropping. I'm going to go into financials are rallying. I'm going to go into that sector and ride that up for a little while. A lot of times there's different pockets that you can move money around, and that's what we call sector rotation. And we see that happen in markets sometimes, where it's actually a good sign of a healthy market when those professionals can find another bull market, another bullish trend to jump into. But what'll happen here soon is that everything will be dropping, and there's nowhere there. Now if Bitcoin's dropping, I can't put my money there. Chip stocks are dropping. If financials are dropping, if industrials are dropping, there can come a point where there's nowhere to go. And by the way, that's a way to keep an eye. That's another reason to keep an eye on the TLT bonds, because as much as bonds have been dropping and as much as those bond yields have been rising, there's a tendency when there's panic in the market that, and especially if there's nowhere else to go, these professionals, out of habit, they'll go into bonds because they're trying to make some return, even though it's not a great return. They're trying to make something instead of just sitting in cash. And so if we see a sell-off day where everything seems to be down, there isn't really any sectors that are up, and you see a nice spike in the TLT and a spike in the VIX, that could be a sign that those professionals are bailing out of the market. They're going into bonds, and they'd really have to want to go into bonds because bonds are not appealing right now. But if they feel like there's nowhere else they want to go right now, that'll be a really key warning sign of maybe a bigger sell-off underway if that were to take place. So that's something to kind of watch for this week as well. I don't know if it'll happen, but that's something just to keep an eye on. All right. Let's go into the portfolio here. We've had some nice gains up to 107,000 now, and let's go through the charts here. OAS is an oil stock, and obviously oil looks like it's taken off. This looks like it can start to break out here. I still like the pattern. I had my stop right down below there, so we got close to stopping out, but now it's paying off. I may add some more oil stocks just because I really think the oil is going to go on a run. The defensive stocks, the aerospace stocks have been just kind of flat a little bit here, but this is looking like it could be breaking out soon. I like those patterns. I'm still holding those. Lockheed Martin's up a little bit today. But all these are getting real close to breaking out. LHX. And again, this is the ETF. This is our kind of inverse ETF trade on SARK. This was opposite of the ARK Innovation Fund. That's Kathy Wood's fund that she tends to get into more speculative stocks. They were selling off, and as they sell off, this is going up in value. Now, we did drop a little bit today because they actually rallied a little bit yesterday. They had a little bit of a bearish reversal candle on this today. They had a bullish reversal candle. If we look at ARKK, if you want to see the opposite of this, this is the fund right here, ARKK, ARK Innovation Fund. And it had that little bit of a bullish reversal. More of an indecision candle. Today it tried to rally, but it's fading. And it's looking like it still could drop. So I'm hanging on to this one. I thought, with what happened yesterday, I thought I'd make a decision on that today, but I think I'm going to keep it. It's been a nice hedge. If the market sells off, this should go up in value. And I want to add some some oil stocks. So I'd like to keep that hedge in place a little bit. That if the market does suddenly sell off, that those stocks start to tank, I can have something that's making me money. And then the stocks. This is the bearish ETF for the semiconductor stocks. So as those are dropping, we saw that chart of the SMH continue to move lower, and this is still moving up. These have made me a lot of money during this run up right here. And so, that's just, you might want to throw those into a watch list somewhere that if you do think the market could drop and that those could rally. I'm not basing these trades off of signals. They're just pure trend analysis. You'll notice I'm not, because see, if I would have just been, I'd be just buying into the SOX ETF right now. I got in it down here when it first looked like the market was going to sell off, and those chip stocks were in trouble. I'm not saying you can't still use the signal system. I'm just saying, in this case, it was I wanted to hedge. This is a way to hedge right away. I talked about this earlier. I'm not going to expound on it in this class. It was one of the last two classes where I talked about how markets can fall a lot faster than they rise. And so if you're looking for anything to hedge on a downside, that would be my argument against using the signals for it, is because by the time you get the signal, what we saw right here, you got the big sharp drop, which caused this to spike up. And by the time you get the signal to buy, you're probably near the end of that, or closer to the end of that drop, where you might be wanting to get out. And so I don't know, I'd be wanting to use a signal system with this particular approach. This is just a hedge. I added a healthcare MOH into this one. Hasn't done too well since I got in. I got in right here. My stop is down below here, so I'm willing to give it a little bit of time. It's possible it has this inverse head and shoulders pattern. If it can hold right here, and that could be pretty bullish. We can start to move back up. But I did want to add some. If you go to the watch list here, I'm not going to add all these, but I'll tell you the ones I really like. That are in our watch list. MDTR is looking like it's breaking out. This is an oil stock. It started to. It's kind of back down again. You could give that another day to see if it can clearly break out. USO, I talked about this one. This is just a pure oil play. If you just, and remember, oil and oil stocks don't always move at the same. It's kind of like the gold and gold stocks, gold companies, mining companies. There are days where oil, USO could be down, but Chevron is up and up big, or trends for 2 or 3 days, or vice versa. You're not always going to get oil going up and oil stocks going higher. Oil stocks right now, the companies are making tons of money at these prices, and so they're going to continue to make tons of money, even if the price of oil fluctuates right in this area here. It goes up and down. So, so in this case, what I'm doing is I'm going to get a play on oil itself. If oil continues to trend higher, I want to benefit from that. And then I want to make sure I have another oil stock or two that I can profit from if oil sputters a little bit. But these stocks do well. Marathon is one I keep jumping in and out of. I'm going to get back into this one here. I'm going to put my stop. It looks like it's breaking out. I'm going to put my stop right below here. It's a relatively tight stop, but I'm not taking a lot of risk on a lot of these trades right now just because of how volatile things are. So the stop is about 20. What's that low right there? 24. Let's do 24.15. I was going to just put it below this low right here, but this low is a little bit lower, and it's right in that same area. All right, 24.15. So 300 shares would be about 8,000 in the trade, and less than a 1% portfolio at risk. So that's good. Looks pretty good. So I'm going to go ahead and pull the trigger on that. Alcoa looks good. I'm not going to trade this one, but I like this. This looks like a nice little pullback here. Maybe get a little bit of confirmation, a little bit of a bullish day to maybe signal the end of that pullback, give you a higher low. That's acting like it wants to go higher. You know, see all these, look at all the defensive stocks, or aerospace type stocks are looking good. LMT, it looks like it's getting ready to break out. Late check. Some of these I'm already in. General Dynamics looks like it's getting ready to break out. RTX. Net, I told you I might be jumping back into this one again, but I'd like to see a little bit more strength in the Nasdaq and in the tech sector. I just don't see that yet, so I'm gonna hold off. I am looking this. Hopefully this holds somewhere in this area right here and gives us a higher low and then starts to move back up again. That's why I've got it in the watch list. I can keep an eye on it. Datadog, kind of the same thing. HBK looks pretty nice here. Impulsive move up, a little bit of a corrective move. Probably maybe a little bit more confirmation. Maybe goes to a buy signal. That one's close. Arch, it's a coal stock, looks good. Nice little bullish move today. MVO, see a lot of these oil stocks, they all look really good. VET, Avis. Oh, this is a biotech HRMY, and a little bit of a dip down. Actually, this is pretty good because you get this real sideways move right here. Sometimes you'll get a dip and then it'll come right back again. A lot of times that's a good sign. It'll start taking off at that point. But I don't know. Biotech, I'd want to make sure the market conditions are looking a lot more bullish. There could be a lot more volatility in these stocks. BTU, breaking out. We've been in this one before. See if there's any other ones in the oil sector here. Oh, Devon's back. Devon's right here. 98 strength rank. Oh yeah, that looks nice. Let's add Devon here. Another oil stock. Our stop down below here. Which is about 57.40. Do 150 shares. Let's see, 140 shares. Let's do 130 shares. Keep it around 8,000. Portfolio at risk under 1%. That's good. All right, let's pull the trigger on that. All right, so I added USO, Marathon, and Devon. So I'm really heavy right now with aerospace and energy. I still have about 25,000 in cash. And I got tight stops. We'll just see here. The oil looks like it's moving higher. By the way, that's another reason why I just can't get too caught up with people saying inflation's over and we're at the peak of it or what have you, is because I'm just not seeing it in the oil trade yet, and that's really what's having the most profound effect. A lot of people think it's just because of oil or gasoline. That people are paying more for gasoline. Do some research and find out how much around your world is oil involved in, plastics, things like that. There was talk, I think today, of they were talking about increasing ethanol supplies to try to combat the gasoline prices. And well, it sounds really easy and simple, but what does ethanol come from? Mostly from corn. So we're going to start jacking up corn prices. Now you're talking about that factoring into all types of foods if we're jacking up corn prices, because corn, yes, it could be used for fuel, but it could be used, we eat it, the animals eat it, so it could affect beef prices. And then you got to go to, chemicals that are, you got to grow the stuff. So all the fertilizer stocks and things like that. So that's the problem, is that you think you solve a problem and all you're doing is you're reducing inflation in one area, but you just jacked it up in another area. And that's what a lot of these people don't realize, is the compounding effect. That's why inflation is such a big enemy for the Fed. It's once you get it, it can get out of control, and it gets even worse out of control when people think they've got simple solutions for it. There isn't. And one thing about human nature is that what will we do as far as human nature? We will do more to avoid pain than we will to seek pleasure. And so if we're talking about economic slowdown starting to happen, what happens? Well, people start making dumb decisions because they're trying to avoid the pain or feel like they can prevent the pain. We got to prevent the pain of a recession. Well, a lot of times, you look at history, a lot of times what makes the pain of recessions worse is people trying to alleviate the pain of the recession. Sometimes you have to just kind of bite the bullet and go through it, and that's the best way to do it. But we can prolong it or make it worse trying to prevent it. And I could go on and share stories about that in real life that you probably see in your own life. You solved your problem because you were short in your budget at the end of the month, and you solved the problem because you had a credit card that had the balance on it, so use your credit card to pay the bill. And you're like, all right, that's it. My problems are over now. Except now you made it worse, because next month you got to pay the credit card off, and now you got to use another credit card to pay that off. And we made it through another month. Yeah, you're making the problem worse, thinking that you're fixing it. Down the road, it becomes worse and worse and worse, and then you're filing for bankruptcy. So, yeah, it's fascinating to see these things kind of play out. But be careful. Be careful not to get caught up with, especially when people start making remarks like, "This is it. The worst is definitely behind us," and things like that. We'll see it on the chart. If that's the case, we'll start seeing on the chart behavior, and we'll go from there. By the way, if you want to keep an eye on commodity stocks, or like agricultural stocks that have been doing very well, Mosaic is one. It's a fertilizer stock. Look at that trend going straight up, and probably going to keep going up. IPI. These things are, they're borderline parabolic moves. So I don't want to say just go jump in. If they have some decent pullbacks along the way, you might want to jump in or consider jumping in. But ADM, Archer Daniel Midland, ADM is a big agricultural ETF or stock. Nice uptrend there. All right, I'm going to wrap things up. So have a great week. We'll see you Thursday for the stock specific class. And remember, market is closed on Friday. So don't be making heavy trading plans on Friday. All right. See you on Thursday. Bye, everyone.